Hi, good night, everybody. Today is the 5th of July, 2017. Tonight's webinar is entitled Trading the Chop. I did a few notes about, what I feel applies to this because there's a lot of stuff that I think about saying when I start the webinars, and then during the webinars I usually kind of forget about it. So I've jotted down some key points that I'm kind of going to focus on. So I'm going to run through some of those key points. We'll explain them a little bit as we go along. And then during the webinar, you guys can post your questions. I'll take care of them if they apply at that exact moment to the question that I'm talking about. And if not, we can answer all the questions at the end. But either way, let's get started on trading the chop. So in general, what is a choppy market? Basically, a choppy market is conditions that in kind of hard for me to show too much. Okay, if we're gonna be applying choppy market conversations, let's just take this 5 minute time frame of DWT here into this range. Would this be considered a chop zone? I mean, it could definitely be considered a chop zone within this time frame. So a market condition that seemed to move sideways into a set range, into a set resistance, into a set support range. Intraday traders obviously have a smaller time frame to deal with this issue because we're only looking at smaller time frames. Like I use 5 minutes, 15 minutes, but what if a guy that's using a 1 minute time frame? How much of this range over here would that trader have had troubles to endure? I mean, obviously chart goes up and down within this range here from 10 o'clock all the way up to about 2:30 or so. So that's a good 4.5 hours of pretty much chop zone where this chart's set in this range. So this is defined as a chop zone. It's a sideways action where it doesn't feel like the charts want to go higher, but it doesn't feel like it wants to go lower. Obviously this would be in a bull formation, so you'd be playing this to the upside. So there's many reasons here that you would take the chart long, trying to anticipate a bigger breakout. For example, when the chart came over here and flagged to the upside, you would expect this range to push it to the upside, but here you are with a candle that pushes over the previous highs and then doesn't really do anything. So this is definitely defined as a chop zone within a 5 minute candle. So choppy market conditions could lead to a lot of trouble. Basically, it can hurt you in a lot of ways. For me, one of my focus as far as what can hurt you the most as a trader or a trade-in, and a lot of traders would obviously have to agree that obviously if you took a huge loss, that would money wise that would hurt you a lot. But if you're thinking in the bigger picture, if you're thinking in a bigger time frame as a career, the money isn't really supposed to be the biggest thing that you consider your biggest loss. In anything that you do as far as trading goes, even in life, but I'm not here to talk about life. But as in trade, as far as with trading goes, anything that does damage to your mentality, to your mindset, to your focus, to your determination as to what you want to do, what you want to accomplish. I feel like those things that can hurt you so much more than the money that you can lose. For example, if you lost $1,000 on a day, and and yes, it is money, and so you do obviously feel the hurt of the money that's lost. But what happens with that $1,000 loss is you lose so much more than just the money. You lose the confidence that you've built up, you lose all the strength that you had, you lose the motivation, you lose the trust in your system, you lose the trust in people that are around you, you lose the trust in the strategy that you've developed. You lose so much more, not just with the money alone. So for me, when I'm talking about choppy markets and what you can lose, I feel like losing mental stability can be so much more hurtful to a trader. And so when you're talking about in coordination with choppy markets, what's going to happen in choppy markets is that you're going to have trades that are going to work for you right away, and then quickly, just as soon as you had a good trade, you're going to have a loss. and then you're going to take a trade setup again. You're going to have a good trade, then you're going to have a loss, then you're going to have a loss. And so what's going to happen is you're going to end up basically chopping yourself out. Basically ups and downs and continuously ins and outs to try to obviously be profitable. In between that though, you might end up having a red trade or back to back red trades that puts you down into the red ultimately, and you have a loss for the day. But not at the end of the day, it's not just about the money that you ended up losing, because what you've lost during the day while trying to fight for all of this stuff, you've lost a lot of confidence, you've lost a lot of strength, you feel exhausted, you're burnt out. You don't want to feel like you want to do this again. You want to stay out of these conditions. So by putting yourself in a situation where you're continuously up and down or continuously having issues trying to get progress, you end up hurting yourself, because not that it's fear. For me, it's not fear. I've had, as I was trying to say before, in my June month of trading was pretty choppy. The markets have been choppy. The way that I trade has been not the best condition for the way that I trade. I don't trade 1 minute time frames. I don't do scalps. I don't go for those 5 cent moves. I don't trade like that. I like to take a chart. I like to make sure that it's working in the way that I want. I want to add into the chart on dips. I want to use formations to produce a bigger outcome. Sometimes if I can have one or two good trades for the day, that's all I really want. I don't want to be trading 40 tickers for the day. I'm not that type of a day trader. So for my way of trading, having choppy conditions doesn't help. Now, can I trade without choppy? Can I trade in choppy conditions? Of course I could. June month was still a profitable month. It just wasn't even half of what May month was. And so it's not that I cannot trade in a choppy environment. I choose not to trade aggressively in a choppy environment. I choose to reduce my size a lot. I choose to reduce the amount of trades that I want to put on quite a bit. I tend to hit a smaller goal, and I understand that I'm not trying to hit a bigger goal. Say for example, I wanted to make $1,000 a day. In a trending market, in a chart that gives me what I really want to get out of it, I'm okay with trying to get that thousand and more during the day. In a market condition where I know that we're having consistent range bound trades, I'm comfortable making $200 or $300. Now that's a big difference mentally for me than it is for a lot of people. You see, a lot of people, if you want to make $1,000, you want to make $1,000 today, tomorrow, next week, next month. You want to make $1,000 a day, period. And no matter what kind of condition you're presented, and that's a big downfall for a lot of traders. I tend to feel like a lot of traders that set themselves to a certain height all the time, to a certain goal all the time, no matter what the market conditions at. No matter if you can't short charts, because if you can't short charts, you eliminate 50% of your trades, right? And so no matter if you can't do everything, you can't short pigs, that eliminates some of your possibilities for trading there too. What if you don't like playing pig charts or low float charts altogether? That eliminates a whole sector of charts that you can't play. What if you don't like playing ETFs? That eliminates a whole sector of charts that you can't play. What if you can't trade charts that are over $200, like Tesla, Netflix, stuff like that? That eliminates a whole bunch of charts that you can't play. So within all of those limitations, you have basically a set amount of things that you could actually trade, or like you actually want to trade. Now, if you still have the same goals throughout all market conditions, throughout your summer months, throughout your winter months, throughout all of these conditions, if you have the exact same goal for every single day, then you're not adapting yourself and your mind to understand that you cannot produce the same outcome. It's not going to be the same outcomes. You're not going to have the same results. So when you know that your conditions are not what you want them to be, where they are not as clean as you need them to be, things are not working the way that you want them to be, it's okay to not be aggressively trading. It's okay to sit back and relax. It's okay to have days where you don't take a position at all. If it's not the right condition for you, that it's okay, right? If you need to go to the beach and it's raining, then you don't go to the beach because it's not the ideal condition. So if it's not the ideal condition for you to trade, don't trade. It's not a bad thing if you call yourself a day trader and you don't take a trade for it. It doesn't make you a bad day trader. It doesn't make you a person that cannot trade or cannot find charts. It doesn't make you any of those things. It doesn't make you a worse day trader than you were yesterday. It just means that it's not the right flow for you and you're comfortable saying to yourself and to your account, I respect myself and I respect my account not to try to damage things. And when you say you respect yourself, it means that you respect your mentality. You respect your composure. And when you say you respect your account, it means I respect my account not to put my account through this situation. I don't need to be taking DWT long here, stopped out, long here, stopped out, long here, stopped out, long here, stopped out, long here, stopped out. I don't need to do this to my account. When I finally get the long, what do I get? 25 cents out of it. I got stopped out 5 times in between playing this section of this chop. And so, when people say they respect, I say respect accounts a lot, and that's exactly what I mean. You gotta respect your account. You gotta understand that each trade that you take, okay, fine, maybe it was only a $25, $30 loss. Then you times it by 5 times, and you add up your commissions, and then you realize that okay, fine, now I'm down a few $100 for the day. But not only is the money lost, during all of this up and down, you've lost a lot more thing than just actual money. You've lost a lot of strength, a lot of composure, a lot of confidence. You've all these things that you've gained weeks before, days before. What if you even took this chart long here? All of these things that you've gained just in this single morning trade is lost in between here. And it could have been money even. You could have made money here up in this one chart. You could have made money right up to this range and then lost it all back in here. So not only are you going home without any money, but you're going home with a whole lot less conviction or confidence, and that's not something you want to do at all as a trader. You have to be able to understand the difference between a ranging chart and a choppy chart. For this 5-minute chart right now, this is just a choppy chart because there isn't a range here. Now if you go into maybe a bigger chart, I mean there's got to be something that oh man, let me just try to type in a couple of charts and see what comes up here, because I can't really remember. Okay, say for example you're playing this range here on Tesla. Now what I remember talking about this chart today, and the range that this chart has is an ideal. It could even be in a chop like it is here. That's a small chop, yes, but the range that it has is a tradable range. That's a big difference. A range chart, even if it's in a defined support or resistance level, can still have a tradable amount. So is this a chop in the bigger picture? Yes. But is it a range tradable type of a chop? And that's a yes. So there's two different types of things that you wanna kind of distinguish, right? The reason why you would rather play something like this, even if you know it's in a chop, is because the amount of range that it has from top to bottom here is actually a good 4 or 5 points in between. Now that's definitely a big range that you can play on a chart like this. So this chop can be defined as something that you would actually want to play. This is a tradable chop, a range trade, not just a small chop that allows you to only gain 25 cents, 50 cents, but this one can actually give you points on your trade. And so this is a chop that you can play. So when you're looking at charts and you're thinking, okay, well, which ones should I play? Which type of choppy charts should I play? Well, first of all, you want to make sure that the type of range that you're looking at. If your chop zone is between a 50 cent to $1 chop zone, you understand that you could only extract a certain amount from that trade. you understand that if you were lucky enough to catch the bottom of the support area right up to the top of the resistance area, you know that there's only a dollar to make in between that. Now you're not going to be that lucky. You're not going to catch the exact bottom, and you're not going to sell the exact top. So you're trying to figure out if there's a $1 range, then I could probably try to make 40 or 50 cents on this trade if I'm lucky enough to catch it when it starts curling and sell it when it starts coming down. So understanding the type of a range that you have determines which one of the chops that you actually want to play. When you have a tight chop and you're feeling like I need to be in that trade, stop yourself. You know, just stop yourself from trading completely. If you understand that your chop is only worth 25 cents and why you putting yourself in that situation in the first place, what can you get from that trade? What can you take home from that chart? By the time you get into it and you have to sell it, unless you're playing size where it really you're only playing for 5-10 cents, and I guess that's good range bound for you. I guess that works out range bound for you. It doesn't work out range bound for me. It's not the way that I trade. So I don't even see that as a tradable range at all. I guess I'm kind of, it would be kind of incorrect for me to say that 25 cents isn't a lot. But it really isn't unless I'm playing something like CERU. Not 25 cents is a big deal on that chart. But if I'm playing something like Tesla, 25 cents is nothing. That's probably just a spread on this thing. So the way that I trade, 25 cents isn't nothing, and that's not the kind of move that I'm going for. So I guess it would be inaccurate for me to say that that 25 cents isn't really a good gain. I guess it's not a good gain for me, for my style of trading. But on a chart like this one with 4 or 5 points, that's a range that you can actually trade. My EMAs for the red and black line, these here, 813. They're 813, 50, 200. Okay. Um, yeah, so choppy market conditions test your mindset and your skill set by trying to navigate yourself through the day. Obviously, if you're a day trader, you're trying to navigate through the day. So choppy conditions tend to really affect you a lot. It really tends to put a lot of doubt in your mind as a trader. You guys know that for those of you guys that attend the webinars regularly, you guys know that my focus is really about retaining mindset, retaining you know that position on your mind, that control on your trades, on your mind. And whenever I feel like like that's being tampered with, I understand that it's I need to stop. Like one thing I'll never try to do is to try to intentionally see um, uh, see myself as a trader mentally coming down from where I'm at and continuing to do that through my short trader lifespan, which is, I mean, a lot shorter than a lot of people out there. I've come to realize that it can only get worse the more I try to push it. And so, like for me in June was a very choppy month in general. The markets were choppy. The way that I trade is very choppy, and I felt like it wasn't the right condition for me. So I tend to relax. Um, I tend to relax a lot during conditions like this. And yes, this edit chart is a good example. Because if you're playing this chart on the long side, say you did a 10:30 reversal time, so you got in right here, chart did a nice 813 cross. It gave you tons of reason to get in, right? First you had a 10:30 reversal time, which gave you one reason to get into the chart. Then you had an 813 crossover, which gave you another reason to get into the chart. Then you had a trend break to the upside, which gave you another reason to get into the chart. So you had three reasons right there to get into that chart. And so on this one, right here, you have three reasons to take it long. So you go long edit. Great. Chart works out nice. You get in at $17.40. You get to sell some at $17.80. You make 40 cents. You hold some, stops in the money. You're all good. Fine, chart's working for you. So you thinking that this chart's gonna go higher. Volume came in, gave you all the reasons to do it. So you wanna go heavy on the chart. So what do? You hang on for a while, chart's holding in, so fine. Chart makes a break to the upside, and what do? You add size into it. This is a prime example of a fake breakout. Chart actually never holds over the breakout and gives you a complete fake breakout. Now you have size into this chart, and then it quickly flushes and stops you out. For possibly, if you add in size over here, for possibly, just in case you were trying to give the chart some more room, because the chart obviously was in a nice bull flag all day and the pennant tried to break up to the upside, so you're thinking, okay, well, this gotta go. You add size into it, and then you end up maybe losing some of this money or all of this money now because you had size here. Maybe you lost all of the money that you made. So this would be a perfect day trading example of what a situation like that can get you into. How do you know though where was the chop, and how do you know where to eliminate that? Well, for me, couple things that I need to see when I'm breaking out of a chop situation. This is a little further down in my notes, but I guess I'm down here. I'm on this chart already, and so let's just kind of go through that. What I like to see on a breakout chart, what I like to see into any kind of strength is I like to see volume into the breakout. When a chart breaks out for me and I don't see volume, see this candle bar here, you see that volume bar there? That's not a strong volume bar, right? And so the volume on the breakout is weak, which gives me the reason to say, well, I do want to add because it is a flag break to the upside, but do I really want to add? And so that's going to cause me to hesitate a little bit from adding into that breakout because of that volume bar. Now the next candle that comes up, what do we have? Candle opened here, opened inside, popped right up, broke over the previous highs, and then failed. And so this setup right here is going to cause me not to want to add into the chart for good reasons. Wicks at the top, inverted hammer, shooting star, red bearish engulfing, doji, shooting star. So for these patterns right here are not going to want me to add into this trade, even though it is a flag, even though it's a bull trend to the upside. I can't add into this pattern here because there is no volume supporting the breakout. So for me, when I'm trying to play the chop and I'm trying to get a chart that's going to give me the continuation out of the chop, even though you have charts that break out, just like this one, a perfect formation for a breakout, there has to be a reason for you to say, yes, I think the breakout's going to work, or no, I think that breakout is not going to work, and we'll put that as a fake breakout for right now until something different happens. Just because the formation broke out to the upside doesn't mean you have to go all gung-ho and say, well, I'm going to take this chart, I'm going to add into this breakout area because the formation says that it has to work. The formation doesn't guarantee you having a breakout. What guarantees you having continuation is buyers. If you're long, it's buyers. You need money coming in to have the chart go. You have to have somebody hitting the ask to make the chart go. The charts are not going to go if somebody isn't buying. Always understand that a formation is a formation, but if it doesn't have the support of the volume coming in, if it doesn't have a buyer saying, I will take your shares and to sell them higher later on, if you don't have that person coming in and saying, hey, I am taking that position here because I intend to sell it higher later on, if you don't have that person, but instead what you're having is you're having a person that's saying, hey, I'm going to test a little position here, maybe it goes higher. If you don't have that guarantee with the volume coming in, if you don't have that person with the strength coming in, that's what the volume represents, right? If you don't have that, then you shouldn't be that guy that's going to be the person that's going to put your money to work. Let somebody else's money work first. Let somebody else with bigger pockets push the charts to where they need to be. Say, for example, the chart kept going and you had You had the bigger breakout candle, and even if it opened in the inside candle, but the next one came up and closed above, if you started to see candles that looking like this, stronger candles that looking like this, you can add into any one of these as long as your volume bars were adjusting to the move. If you were seeing buyers coming into this area here instead of seeing nothing coming in, then you can adjust your position now to facilitate a bigger move to the upside. But for right now, you wouldn't have had any reason to add into this breakout. So this is a prime example of a fake breakout, especially dealing with with choppy charts. This could have been a flat chart. It could have been chopping like this for a whole bunch of times. It could have been in and out, in and out, in and out. Then you see something like that and it comes right back in. This would be considered a fake breakout. How would you notice where the fake breakouts are? Well, this is gonna be determined by the volume over here. If your volume over here is not evident, if the volume is not supporting that move to the upside, then that is where your fake breakouts are. If you're short also, or if sometimes you get the volume that comes down like this and you add into that short position only to see it push right back up into the upside. And so this over here, to determine this area here, again, the volume is going to determine what's going to happen with these moves. So this is a prime example of a fake break to the upside. This is a prime example of a fake break to the downside. And this is your choppy scenario. This condition right here, the fake breakout, is where a lot of traders actually lose a lot of money. And that scenario is right here. So you didn't have a position in edit at all, but you brought it up on the side and you said, yes, I want to take this chart to the upside. So what do? You draw your trends and you wait for it. Okay, fine. I draw my trends and I wait for it. The chart broke to the upside. Bang, I'm in. Full size because you're thinking you want to go long. This is where a lot of traders actually lose a lot of money trying to trade the chop. So you get chopped out of a choppy chart because there is no support in volume down in that level. There's no support in volume for this breakout in this range here. Always understand what's happening up here and who's buying it down here. You got to be sure that you have a volume bar on your chart. See the difference here? When you had the volume bar, fine. You see this difference here? That's a big difference. You have to be able to see that difference. This difference represents here. Why did we get the move to the upside? Because we did have an increase of volume. So you had strength that supported the move. Over here, breakout, no strength to support the move. So it's a big difference. So make sure that you have volume on your make sure that you have volume indicators on your chart so that you can kind of get to see that. Now, do you have to understand everything that goes on with it? Do you have to understand anything other than green and red bars? No. You don't need to understand all of the stuff that goes on with it. All you really have to do is be able to see colors, green and red. You know, green means buy and red means sell. Keep it simple, stupid all the time. Keep it as simple and as stupid as you could. And don't let people complicate your stuff. Oh, do you need to know where it's at, or how much exactly printed, or what kind of blocks went through? No. Can you see reds and greens? And keep it as simple as you could. Somebody says there's a breakout on edit right there at the top, flag break to the upside. You say, okay, that's cool. Show me the money. When they show you the money, when you start seeing bars down here that represents the money, then you play your chart. You don't need to force that breakout. If this chart was to go higher, where are two places that you can play this chart? Obviously, if you miss the breakout here and there's nothing to support the move, so you don't take it, where can you play the next breakout, which isn't far from where it's at anyways? The next breakout would be a high of day break. Then you'd be looking for a similar setup. You'd need volume to come over. You'd need the chart to get retested. You'd need a lot of stuff. But if you fail to get in here and the chart was to move and you didn't get the volume here and you said, hey, I didn't feel comfortable taking that trade because I didn't see the volume. I didn't see the need to take the chart. And if it continues to go, you have another area that you can take the chart. Never feel like you need to chase stuff. Never feel like, hey, I need to keep moving on this chart here, even if I don't see volume coming in, even if I don't see a reason for buying it. When a chart breaks a technical formation like this, which is pretty much a bull flag, we had buyers coming in from the inside, chart pennants out for a while, flags, breaks to the upside. That's a bull flag setup. That's a trader's dream type of breakout, right? So why didn't the chart go? So why didn't it go? So that means what? That means that formations alone doesn't make charts work. That means that setups alone doesn't make charts work. So you can have an 813, you can have it over the 50 EMA, you can have a flag breakout, you can have an inverted head and shoulder, you can have a higher low, you can have a green Maribozu breakout candle here. So what does that tell you about candlesticks, formations, moving averages, all of the above? It doesn't work unless you have the buyers coming in, unless you have the money coming in to support the moves. You can have a flag, an inverted head and shoulder, and 813 on any single chart. Any single chart of formation out there, you can have all of these formations and they all can fail on you. So what's the most underlying thing here? The buyers. Wait for the money. You gotta get the money. So into choppy situations especially, wait for the money. So I hope that helps to understand a little bit, especially about breakouts, especially in choppy situations. The worst thing you want to do in choppy situations is be the first person to always be the buyer. You don't need to be the buyer. Your 500 shares or 1,000 shares is not making that chart go. It's not. Even if you want to be the first guy there and you feel like you need to get it 15 cents cheaper than the other person, then you're not doing anything that's helping your account or your mental status. What you're doing is putting yourself in a pressure situation so that you can make an extra 15 cents. And at the end of the day, did the extra 15 cents really make such a big difference for your limited amount of shares? And the answer is no. It really won't make a big difference. It can't make a big difference because that's not what you're playing for anyways. If you're playing for a $1 move and you're stretching yourself to get an extra 15 cents on your entry, then what's the difference? What's the purpose? I'd rather get a 50-cent move on a strong chart and a clean breakout than get an 85-cent move on something that I had to risk a lot and put myself through a lot of pressure to get. Now I don't know if that's coming across clearly enough, but for me, I'd rather take less money on a stronger breakout, a stronger chart, on a better formation than make a little bit more and putting myself through an hour or half hour of stress and aggravation and seeing reds and figuring out if to add and doing all this whole bunch of other crap. I'd rather get a strong 50-cent move than a stressed out 85-cent move, if that makes any sense whatsoever. But I still have some stuff written down, so let's try to see if I can read some of that. I've probably talked about a lot of them anyways, but anyways, let's go through. Good ways to determine chop versus consolidation is to look at the chart on a bigger time frame. Any small chart can seem like a chop. Any small time frame can seem like a chop. If you're dealing with a 1 minute time frame and you have 10 minutes of the charts moving into a 10-cent range, that's considered a chop, because you're dealing with a 1 minute time frame, so that's 10 candles in between a 10-minute time frame. If you're dealing with that same 10 minute in a 5-minute time frame, that's only 2 candlesticks. Maybe that's not a chop at all, maybe it's just 2 candlesticks. So any single time frame that you're using could be, you could obviously see it in a ton of different ways. What if you're only using a 10-minute time frame? A 10-minute time frame would only have 1 candle. You're using the 1 minute time frame would have 10 candles. So the visual, the way that you're seeing the things, the outlook of it, obviously can be completely different, because what you see on a tighter time frame is completely different to what you can see on a bigger time frame. A 1 minute time frame trader could be out of that chart because of 10 minutes of quote unquote chop, while you remain in the chart to get a much bigger move. And there were some situations even on the chart that I took today on BZUN that could have been considered a choppy situation if you were trading with a smaller time frame. Any one of these situations here could have been taken into a chop zone consideration and a possible reason to get out of the trade if you were trading in a much smaller time frame. It'd be a lot of ups and downs and ups and downs, and you probably would have said, hey, this is too choppy for me, I want to exit the position. But me, I was already on a bigger time frame. Using a 15-minute time frame kept me into the chart long enough to stay as clean as possible. And so I had no reason, and I kept saying that to the room today. This chart's just not giving me a reason to sell. So if I can't sell, if you're not telling me you're going lower, if you're not telling me you want to fail, then you know what? I'm just gonna add into dips, and we'll see how it works. And I've said this many times before. A good chart, it should be able to add at any point, even if you don't have that perfect bottom pull. A good chart should be able to handle and add wherever, whenever, because it should always be trending in the direction that you want it to be, the direction that you're playing it. And this chart, I ended up doing my first buy at 22.50, and I added 3 times on the chart. 4 times on the chart, because I ended up having 2,500 shares. Or did I do 1,000 share add at one point, and then it was 3 times? Now I can't remember. But I did add a few times on this chart, because as I said, the chart wasn't giving me a reason to sell it. So if I feel like the chart's gonna go higher, then I wanna try to make more on the chart. So I added continuously on the chart, and obviously it was strong enough to hold for the entire move all the way up to the end. It pretty much almost closed into the high of day, and so it was a beautiful trade all day. I still have some stuff here. Chasing moves on choppy days can be very dangerous. Many charts would provide a clean false hope breakout. I think I went over that with that edit play pretty well. False breakout leads to most money and most mental losses. False breakouts can be seen with indecision candles. Okay, so then that's one of the things I forgot to say about the types of candlesticks when you're looking into the breakout areas, when you're looking into the charts that are breaking out, into the chop zones that are breaking out. The candlesticks themselves should read something for you. Even if you're not looking at the volume, which you should, but even if you weren't, the candlesticks will depict a lot. Candlestick will tell you, hey, am I breaking out with strength? Am I breaking out with a strong candle? Am I being bought from the beginning to the end of that time frame, that 5-minute candle that you're playing with, or 15-minute time frame candle that you're playing with? Is my volume strong enough to continue that one candle breakout, or is it a weak volume? How do you know if it's a weak volume on a candle? We just look and see where the wicks are at. If the wicks are at the top, that means there were more sellers because the chart was pushed back down. If the wicks are at the bottom, that means there are buyers because they kept pushing it up. So again, keep it simple. And so the wicks at the top usually signal that there are sellers. Wicks at the bottom usually signals that there are buyers. So try to keep it as simple as you could, especially with the candles. So your candlesticks are also gonna give you a decision as far as, hey, are we strong here? Should I be adding into this chart if I have an inverted hammer into a breakout? Should I be adding into this chart if there's a doji at the top? Should I really be adding into the chart if I see a shooting star into a breakout chart? And the answer is no. And so when you do add into the chart, because what? Because you saw a formation, but you know better than adding into that chart. You know there's no volume, and you see sellers, you see the wicks at the top, and you still want to add into it. That has a lot to do with your mental game. That has a lot to do with you saying, well, I just need to make money, period. That chart has to work, period. And there's nothing that you can do to change the outcome of certain things. There's nothing that you can do as a trader to change the outcome of a chart, if it goes higher, if it goes lower, unless you have that kind of control with that kind of money and that kind of power. Good for you. But other than that, there's a 99% likelihood that you cannot make that chart go higher or lower, no matter what you do to it. Unless, obviously, the float's that low also, right? But there's nothing that you can do to make it go higher. So what do? You adapt to the chart itself. You don't say the chart's going higher because I'm in it. You say the chart's not going higher because that candlestick, that volume bar, does not allow the chart to go higher. So you don't add into the chart. You don't force it to do something that it cannot do. For me, trading into the chop for the last month, I've understood that I can't force the charts to do what I wanted to do. But what I ended up doing is, because of the style that I trade, I ended up chopping myself out of a lot of trades. I ended up stopping myself out from a lot of trades. When I put stops into my small positions, my starter positions, they're usually a wider area or a designated area to be in. So for example, with this BZUN, okay, let's go back to the edit because that's a good example. If I was doing a long on this breakout here, just because I needed to trade and I had to trade the breakout, so I took a long entry on edit, and say I wanted a 1500 shares on a chart like this, so I took 500 shares to start off with right into the breakout. I'm long at $17.80. I top ticked it right there at $17.80 long. My stop on a chart like this is going to be at the next area, the next pivot point. So knowing that that's at 80 and that's at 57, my stops are probably at 50. So I just lost 30 cents on $500. And so that's kind of the risk that I would take on a chart like this if I played that breakout there to the upside. Now if I was just sitting here looking at the breakout to the upside and wanting to trade, like just picture me trying to force a trade. And so I want to trade, I need to trade, I have to trade. That's a flag breakout to the upside, I must take it. So that's my mentality, right? Because I'm anxious to trade. And so I took the chart, and instead of doing a small starter size, well, here we go. We got a breakout. That's what we've been waiting for from 11:30 till 2:30. I've been waiting for this breakout. So now that I get the breakout, I'm so anxious. What do? I go 1,000 shares or 1,500 shares right away. That's your problem right there. So no matter what, no matter where, you still have to assume that it's a new setup, right? So forget that I wouldn't have taken this breakout anyways because it doesn't have the support in volume, right? But say I needed to take the chart and I made all the mistakes at one time. I'm anxiously waiting for the chart to break out to the upside. It does break. I top tick it, first of all. I go full size, secondly. There's nothing else here to support the move. I'm buying a chart long when my stochastics are already hot, and I got wicks at the top. All the reasons for me to say, hey dude, slow down, don't take that chart so aggressively. But what do? Because I'm anxious to trade, so I want to take it. So I took it full size right at the top. Where do I put my stop? Luckily with that size I'll have a tight stop and I'll probably get stopped out right here. So I'll be out of the trade anyways, but if I had 1,500 shares, 25 cents does add up quickly. So I'd make that mistake right there. Get this would be a false breakout play. This right here, not that I'm such an experienced trader that I can call people rookies or anything, but this right here is a very stereotypical rookie breakout type of a trade. And not that anybody is, because I've taken trades like this myself. We all make mistakes, and you look back at it and you're like, but why did I do it, right? But we all do it anyways. And so even if I was to take this chart and I looked back at it, I would call myself, I would say, hey dude, that was a rookie trade right there. Like, why'd you take it? What was the reason for it? And I do this to myself when I do my Saturday journals. I go back through all of my charts all day throughout my trades. Whenever I take an entry, whenever I take a reason, and what I'll do is I'll do this, I'll do a circle, I'll do some arrows, sometimes I'll write some notes on it, and then I'll snip the whole thing, and I have like an entire week's folder that I'll just throw them in the folder. And then so when I do the reviews on Saturday, I can go over every trade. I can see why I took the trade, because if I go over this same chart on Saturday, I won't remember why I took this trade to the upside. So what I'll do is I'll circle that area, I'll draw my flag, I'll snip it, throw it in the file. So that way when we review on Saturday, I'll understand exactly what I was thinking when I took that trade or when I took that chart. And so when I do this review on Saturday now and I see this here and I say, well, there's my long, right? Why did I take it? Okay, trade failed. I'll know the trade failed because obviously my trade logs are going to reflect that. The trade failed. I lost X amount of dollars. Why did I take the trade? So then what is this going to do to me after I see it now? Well, not only do I understand why I took the trade in the first place, but I can relate now to it in past tense. What happened after I took the trade with the incorrect criteria? Well, the trade failed on me. That's what happened. And so understanding that when I do write my journal, it costs me money to learn a lesson there, but did I learn a lesson? And is that something that I should use further for my future trades? When I see a chart with wicks at the top with no volume breaking out, should I take that one? Right, so if this chart was to cost me $300 to learn a lesson, is that $300 that's worth money, that's worth time, that's worth experience? And of course it is, because that trade right there, and the only way you can understand how that works is because if by taking a journal, by being able to go back to your trades and seeing what you did before. Otherwise, on Saturday, all I'll see on this is EDIT minus $300. What happened? I don't know what happened. How did I learn from it? Well, I didn't learn jack. I didn't learn nothing from it because all I see is Wednesday EDIT minus $300. That's all I see. On my trading log, it doesn't say, hey, well, you took this chart in a breakout and it failed. It doesn't say that. It just says the gains or loss, and it's just gonna say red 300, nothing else. So how do you distinguish that for yourself? How do you learn from these things? How do you make yourself better? I snip it. It doesn't take 2 seconds to just hit that snip button and just snip it. Or if you have a print screen button, just print screen and save it in a file, so that when you go back on Saturday, you can delete all your files on Saturday if you feel like it's taking up a lot of your space on your PC. Just dump them in a folder and delete it on Saturday after you're done reviewing your stuff. And at least you understand what mindset were you in while you were taking that trade, so that when you review it properly, you can see where you were at. You can see what you were thinking. I can say to myself, well, it did break to the upside. So, okay, this chart did break to the upside. So then, what have I learned? And that's the only way that you'll be able to really kind of progress as a trader and progress in using your journals correctly, not just to log your wins and losses, not just to see that cool pie chart, not just to see your 65% win-loss ratio for the month, not for that cool stuff, but really to see what's working and what's not working. So again, I mean, this has nothing to do with the journal writing, but I guess we'll have to do a whole webinar on that, because that's just super important for you to really kind of understand what you're doing when you're doing it. I do have notes written down, but I think I'm going through most of them. What kind of charts do you find working or not working in choppy market conditions? I tend to see more manipulated charts being played during unsure market conditions. Unsure market conditions like some of the conditions that we've been having recently, where charts would open up higher, push through, make a new high of day, and completely fail. And so this chart today, I think I did like this. I got chopped up in Cara, CARA. Huge push, strong candle, first chart. First candle, bullish engulfing, chart broke. I took the chart at $17. $17 exactly on the long side, anticipating a break, risk down to the low. I got stopped out on this chart on the long side. Because obviously, should I have played it differently? I felt fair enough with the volume coming in. I felt fair enough with the initial reaction on the chart. I felt fair enough with the candle opening above, even though it was still pretty much an inside candle, but it did kind of open right up to the top side of the candle and not to the bottom end. So I felt like it was going to push to the upside. So I took it on the long side. I got stopped out on this one for 50 cents because that's the range that I had to put onto the chart. So 17 to 16.50 is where I got stopped out on this trade. But this is a good example of a fake, or I don't know if I should call it a fake break, because I don't think there was enough data on the chart to really kind of distinguish anything there. But it definitely didn't work for me, and so I understood that. So I took my loss and I was out. I didn't try to play it again. I didn't try to play a double bottom. I didn't try to pick it. I didn't try to really do anything with it. Later on during the day, though, I did call at 15 for a chart to start moving back to the upside, and it only closed at 15.30. Wasn't really a big move. But in choppy market conditions, I find that we see a lot more manipulated types of charts. I find that we see a lot more low floater moves. I find like we see a lot of things like this happen, and so this is these are things that you're gonna see happen more and more, because can you manipulate Priceline or Amazon? No, you can't. Can you go about manipulating Tesla or Netflix? You really can't. And so can you kind of, not you individually, but can enough money manipulate charts like these? And that's the answer, would be kind of yes. And so I tend to see like a lot more of these types of charts reacting during choppy conditions. For my last piece on my notes, if you don't feel comfortable trading where you feel like you're not getting any traction or any direction, you should just stop. And that's the way that I felt in June. I didn't stop completely, but I stopped comparison to what I was trading the month before. If I was trading 7 charts a day in June, I was basically trading 102. And sometimes I'd have 102 or 3 back-to-back-to-back charts. It just fails on me. Setups, breakouts, this sort of stuff, even with volume charts, were just failing. And so I tend to really, really reduce the amount of stuff that I did. I felt like I wasn't getting traction. And so I basically stopped trading a lot of stuff. Um, Most traders would just see it to keep going on, or hey, you don't know how to trade if you're not trading aggressively. I think that's so much BS. And the more a trader encourages you to trade outside of your realm, the more hurt it's going to do to you and to your account. The more a trader tells you, if a friend tells you, or if a trading friend that you have tells you, hey, so you're not trading that, you can't do it. You're not good enough to make money in this market. If somebody has to talk to you like that or tell you stuff like that, they're not trying to help you at all, because they don't understand where you're at. They don't understand where your account's at. They don't understand where your mindset's at. And so they should not be talking to you like that or trying to force you to trade. If you see people on Twitter trying to say, hey, well, I made so and so amount of dollars today, and I have a 90% win loss ratio, good markets, bad markets, whatever. That's not you, and you shouldn't fall victim to other people's hopes, or false hopes sometimes, of what trading should be. And so for as individual traders, don't ever feel compelled to trade in an environment that you're not relaxed in. If you're not relaxed in an environment, then why you trade in that environment? So don't trade in an environment where you don't feel comfortable. If you're not at your peak condition, or you don't have to be like superstar condition, but if you're not feeling good about it, just don't do it. That's all. You're not losing money if you're not spending money. And if you don't trade today, doesn't mean that the market's shut down. Because if you trade today and you make money, the markets continue. The market's going to be open tomorrow. If you trade today aggressively, forcefully, overtrade, and you blow up your account, the market's still going to be open tomorrow. See, that's the thing. A lot of people feel like it's going to be shut down, the end of the world. No, it's your end of your world, not the market. Market won't even realize you're gone. You think the market volume is going to be less tomorrow if you don't trade? Think anybody's going to remember you if you don't trade? You think E-Trade or Scott Trade or Short Trader is going to even notice if you're not there, if your account's blowing up? No, they don't give a crap about you. People on Twitter don't give a crap about you. You should give a crap about yourself and about your account. If your conditions are not suitable for you, then stop trading. It's not the end of the world if you don't trade. If you say to me, hey, the conditions were just too shitty, I just didn't want to trade, I'd say, good for you, you did the best thing. I respect that more than you saying to me, I traded 60 tickers today. More, I respect you so much more if you say I didn't trade anything, than if you say, hey, I overtraded. I know I shouldn't have overtraded, but I still did. I traded a crap load of tickers. I have $600 worth of commission. You see, that person, I have to say that there's a point where you give up all respect for your account at a certain point. You say, I don't give a shit, and I need to make money no matter what. And if that's the person you end up being, then eventually you'll end up being the person that's not trading anymore. A lot of people that stop trading, they don't stop because they want to. They stop because they have to. When you see people that fail trading, they didn't fail because they want to. They didn't just jump into their account one day and took out $50,000. They stopped trading because they lost money. They lost all their money. They can't do it anymore. They didn't stop trading because they wanted to, because the life was so great and all their stuff they wanted was bought up, so they just stopped trading. No, they stopped trading because they didn't have money. So you have to be able to protect your money at all costs. And the conditions that you're going to be trading in, the conditions that you allow yourself to trade in, determines how badly you really want this. Do you really need to force your account to make money in choppy situations? Do you really need to put yourself in situations where you know you can't make money? No. Keep your money. Play when the conditions are suitable for you. Again, like I said before, if it's not a beach day, don't go out on the beach, right? If it's pouring rain, you're not sitting on the beach tanning. So if it's not suitable conditions for you to trade, then don't trade. And it's okay. Sitting out the chop, sitting out conditions that are not not in your environment, that are not really what you want it to be, that's okay. Because the best lesson that you can end up taking home from sitting out the chop rather than trading the chop is something that nobody else can take away from you, and that's experience. You're gonna gain that by being in this career. You're gonna gain experience not by trading for 6 months and blowing up your account. You're gonna gain experience from trading from 2 years and sitting out the chop and defining when you want to trade. But you can't gain experience if you don't have money. Now, some of the best traders out there, you probably see them that they can talk you to death about trading, but they don't trade. So why do you know so much stuff and you don't trade? Because they don't have money. Because if they knew so much stuff, they would be trading, right? So sometimes you just have to filter out the stuff that doesn't apply to you. And if your criteria are not being met, if you feel like you're stuck in chop zones, if you feel like things are not working the way that you want it to work, relax, sit it out, shut it down. If you're hanging out with me, you know I'll talk all day long, so it doesn't matter if you're trading or not, you'll still learn something. Either way, if your situation isn't what you want it to be, don't do it. Alright, so I think I'm going to wrap it up on this webinar for today. I don't think I have anything much more written down, but I can give you all the text that I have written down, so if you want to read over any of the points, I probably missed out some of them. But I'm going to stop recording now.